All righty. Well, housing starts. This is an October number. We're looking for a number somewhat above 1.4 million, and that's exactly what we had, 1,425,000. And, of course, that's seasonally adjusted annualized units. And if we look at permits, it's also very close to expectations, 1,526,000. So these numbers aren't surprising. And if I look at the start side, what's interesting here is at 1,526,000, it's still one of the lightest numbers that we've had recently. One of the high water marks is 1,566,000 last month, which was downgraded just a bit. Now, let's get into Philly Fed, shall we? Philly Fed expected down 6 is much worse at down 19.4, down 19.4. We have to go all the way back to May of 2020 to find a weaker number. And once again, just like industrial production capacity utilization, this isn't painting a good manufacturing type number. Initial jobless claims, 222,000, which ends up being down 4,000 from last week's slightly revised 226,000. And on the continuing claims front, 1,507,000. That follows 1,494,000. And both those numbers are very close to expectations. We all know that inversions gone wild yesterday. 2s to 10s reached levels we haven't seen an inversion in 4 decades. And 3 months to 10s, the real recession spread, reached a minus 55 that I saw. It's now under minus 50, hovering in a minus high 40s. But yesterday's close was the most inverted in 15 and a half years. And, of course, we continue to monitor all that is housing. I'm sure Diana Olick will weigh in on this. On the housing starts and permits front, we continue to see that interest rates, of course, are slowing housing. The Fed goal is to slow not only housing but the rest of the economy. Is that a good idea? It didn't sound like Barry thought so. Becky, back to you.
All right, Rick, thank you. Let's get some instant reaction from our own Steve Leisman and Diana Olick. Diana, let's start with you.
Well, as Rick said, these are right along expectations, really. But when you break out the numbers between single family and multifamily, which that's the total number Rick gave you, single family is really having a lot more trouble. And that's what we're focused on with the home builders and obviously with mortgage rates and the impact of that. And you're seeing the year over year comparisons widen. Housing starts for single family we're down 22% year over year. That compares to 17% last month annually. And then building permits the same. They're in the 20s versus in the teens. So we're seeing that widen, that annual comparison. And, when you talk to the builders, they're like, well, we're going to get more incentives in there. We're going to help buyers potentially buy down their mortgage rates. And they're doing all those kinds of things to help. But obviously, when they look into the future, they don't want to put up more homes when they know that they can't sell these. And we saw in the home builder sentiment numbers yesterday, again, these added incentives, a huge jump in the number of builders reporting incentives. And that's really going to hit the bottom line when we get to the earnings, because the previous earnings we've seen, which were pretty good from the builders, were all based on homes that were sold 6 months ago before mortgage rates were quite this high.
Wow. Wow. Steve, weigh in. What do you think? Jobless claims and the rest?
Well, I think what the story here is that, as Barry has been talking about the past hour, and Diana as well, the housing market is in recession, and firmly so. And the trouble for the Fed is that the rest of the economy is not. And you can throw things at me if you like, but I'm just saying what they're saying here. And what you have is you got somebody like Jim Bullard from the St. Louis Fed coming on at 8 o'clock and saying explicitly that we're not there yet, and we may not even be close to being there yet. He put out a range of 5% on the low side. Remember, we're at 3.75 to 4% right now, and he's saying we need to get to 5 on the dovish scenario, and maybe as high as 7%. On the hawkish scenario, you have Esther George also saying, I don't see how we get where we need to go without pain in the economy, without a contraction in the economy. And their concern remains inflation here. You have some parts of the economy doing better despite higher interest rates. For example, the auto sector, where there's a lot of pent-up demand and still seems to be going reasonably well. We had decent, very good retail sales numbers yesterday that caused people to upgrade their forecast for the fourth quarter growth. Jobless claims, you do have this creep up we need to watch in continuing claims, but the inputs on the weekly basis, the 222, is not telling you there's very much slack in this labor market. And unfortunately, again, feel free to throw things at me. This is what the Fed wants to see. They want to see an increase in slack in the labor market. That means people losing their jobs.